Are you ready to dive in and explore more of the world of technical analysis? Okay, great. This part of the course becomes very interesting as we study some of the specific mechanics applied by technical analysts when forecasting a security's performance. What you will learn here can be easily practiced, so feel free to start exercising your knowledge with the price development of any given security on charts that are available online. Very well, let's get started. The single most important term in the world of technical analysis is perhaps the word trend. It is the epitome of investor herd mentality or groupthink, following what others are doing at the moment, as people generally do in various types of social environments. In the investment world, this social groupthink is easily visible when, for example, there's a strong demand for a certain stock because its price is increasing, resulting in investors being inclined to buying at higher prices, expecting the price to continue the upward trend. Thus, the word trend designates a direction. Such a direction in the context of chart analysis could be upwards, downwards, or sideways. Here's the S&P 500 chart from 2015 to 2019. See the strong upward trend? It starts at the beginning of 2016 and remains uninterrupted until 2018. We can have downward trends too. Here's how a downward trend looks like. This one in particular has to do with the financial crisis of 2008. As you can see, during an upward or a downward trend, the price doesn't simply go straight upwards or downwards in a perfect line. There are small fluctuations. However, what is typical of an upward trend is that it is characterized by higher peaks and higher troughs, while a downward trend involves lower peaks and lower troughs. See how the troughs in this downward trend are lower than the previous ones? When this pattern stops, we say that there is a retracement. Typically, a retracement would result in a trend reversal or a sideways movement. At this point, we need to introduce a couple of additional concepts that are widely used by chart technicians: support and resistance levels. The support level is a price level that is expected to protect a security's price from falling substantially. Think of the support level as a floor price acting as a buffer zone, supporting the price of a security from going lower. At this price level, investors are expected to buy more of the particular security rather than selling it. The underlying idea is that most investors are familiar with technical analysis, and they all see the support level coming up. So that's the area when many traders decide that the security has reached its lowest price during the trading session and will start buying, expecting that the price will begin to increase. Of course, in certain situations, the price of a security will break through the support level. This is usually a signal for even further losses, perhaps until the next support level is reached. So, how do we spot a support level? These are typically the most significant dips in your chart. And if you see that an asset has responded several times to a certain support level, chances are it will do so again. A resistance level, on the other hand, is the opposite. It is seen by investors as a cap or a ceiling in the price level of a security. When the price reaches the cap, this most probably means that the security is headed downwards. Resistances are easy to spot too. Just look at a chart and try to identify how many mountain hills you see. These peaks are your resistance levels at different price levels. All right, excellent. Another important principle of technical analysis is the change in polarity. This is the idea that once a support level is breached, it becomes a resistance level. If Tesla's stock prices had a support level at $230 that was breached, then $230 becomes the new resistance level and vice versa. Quite interesting, isn't it?